Preparing for a EY GDS FP&A interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is the role of FP&A within a finance organization? FP&A connects finance with business decisions. I would explain that the function owns budgeting, forecasting, performance analysis, management reporting, and scenario planning, while partnering with operational leaders. Its value is not simply producing reports. It is explaining what changed, why it changed, and what management should do next. For example, if revenue declines, FP&A would isolate volume, price, mix, and timing drivers before recommending corrective actions and updating the outlook. While answering, focus on planning, forecasting, management reporting, variance analysis, decision support, business partnering, and how FP&A converts financial information into forward-looking actions. Question 2. How would you prepare an annual budget? I begin by translating corporate strategy into measurable financial targets. Then I gather assumptions from business owners, including volumes, pricing, headcount, utilization, inflation, and planned investments. I build revenue and cost schedules, challenge inconsistencies, reconcile bottom-up submissions with top-down targets, and document approvals. After loading the approved budget into the EPM system, I validate totals, establish reporting baselines, and communicate ownership of key assumptions so performance can be tracked consistently. Make sure to cover strategic objectives, operating assumptions, revenue and cost drivers, stakeholder ownership, bottom-up and top-down alignment, review cycles, system controls, and final approval. Question 3. How do you build a reliable financial forecast? A reliable forecast combines actual performance with operational drivers rather than relying on a simple percentage adjustment. I start with current year actuals, analyze seasonality and run rates, then forecast revenue, headcount, utilization, expenses, and cash using business assumptions. I challenge unsupported optimism, model downside and upside cases, and reconcile the forecast to the ledger. Finally, I compare forecast accuracy over time and refine assumptions based on observed bias. In your answer, talk about historical trends, operational drivers, actual to-date results, stakeholder input, seasonality, risks, sensitivities, forecast frequency, and reconciliation to the general ledger. Question 4. What is variance analysis, and how would you present it to management? Variance analysis explains the economic reasons behind differences from plan. I would first quantify material variances, then separate timing effects from structural issues and analyze drivers such as volume, price, mix, headcount, foreign exchange, and one-time items. My management commentary would state the impact, root cause, business owner, and expected resolution. I would avoid merely reporting unfavorable numbers and instead connect each variance to an action or forecast adjustment. Be sure to mention budget versus actual comparisons, price-volume mix analysis, timing versus permanent variances, materiality, root causes, ownership, corrective actions, and concise executive communication. Question 5. How would you explain a significant unfavorable expense variance? I would not assume the variance reflects overspending. First, I would validate the ledger mapping, accruals, exchange rates, and period cutoff. Then I would decompose the difference into timing, volume, rate, reclassification, and one-time factors. I would discuss the findings with the cost owner, determine whether the issue is controllable, and update the forecast if necessary. My final message would distinguish the accounting explanation from the underlying operational story. Focus on validating the data, decomposing the variance, checking accruals and timing, speaking with process owners, distinguishing controllable from uncontrollable items, and recommending an appropriate response. Question 6. What is driver-based planning, and why is it useful? Driver-based planning links financial outcomes to measurable business activity. For example, revenue may equal customers multiplied by average price, while personnel cost may depend on headcount, hiring timing, and compensation. I prefer this approach because assumptions are transparent, easier to challenge, and faster to update than numerous manual line items. It also supports sensitivity analysis. Management can see how utilization, pricing, or hiring changes affect profit and capacity. While answering, explain operational drivers, causal relationships, scalability, transparency, sensitivity analysis, ownership, and why driver-based models improve forecast speed and business credibility. Question 7. What do you understand by BPRA at EY GDS? I understand BPRA as a finance-focused capability supporting business process, reporting, and analytics needs through standardized delivery and insight. In an EY GDS context, I would expect strong emphasis on process discipline, data quality, controls, automation, and collaboration with global engagement teams. I would position myself as someone who can execute recurring reporting accurately while also identifying root causes, improving workflows, and translating analysis into useful recommendations for stakeholders. Make sure to cover finance process support, reporting and analytics, standardized delivery, controls, automation, stakeholder service, data quality, and how BPRA can improve decision-making across finance operations. Question 8. Which EPM tools have you used, and how did you apply them? I have worked with EPM environments for budgeting, forecasting, reporting, and management consolidation. My experience includes defining dimensions, loading actuals, maintaining assumptions, validating data, supporting workflow approvals, and investigating reconciliation issues. I focus on understanding the business process behind the tool rather than treating it as a black box. For example, I would use an EPM model to centralize workforce assumptions, improve version control, and shorten forecast cycle turnaround. In your answer, talk about specific platforms, planning or consolidation use cases, dimensions, workflows, data loads, validations, reporting, user access, and measurable process improvements. Question 9. How would you compare Oracle EPM, SAP BPC, and Anaplan? I would compare them based on business requirements rather than claiming one is universally best. Oracle EPM and SAP BPC often integrate strongly with their respective enterprise ecosystems and support structured planning or consolidation. Anaplan is known for flexible connected planning and user-friendly modeling across functions. I would assess data integration, dimensional complexity, workflow, reporting, security, scalability, implementation effort, and support requirements before recommending a platform. Be sure to mention planning architecture, integration, modeling flexibility, workflow, scalability, user experience, reporting, governance, implementation effort, and matching tool choice to business requirements. Question 10. How would you troubleshoot a mismatch between an EPM report and the general ledger? I would begin by defining the exact difference: entity, account, period, currency, and amount. Then I would compare the source ledger extract with the EPM load file, checking mapping tables, hierarchies, exchange rates, journal status, eliminations, and interface logs. I would confirm whether the report uses the same filters and version as the ledger. After isolating the cause, I would correct it, rerun validations, document evidence, and communicate the resolution. Focus on defining the population, checking period and currency, mapping, hierarchies, journal status, interfaces, eliminations, and reconciliation evidence before escalating the issue. Question 11. How can finance transformation improve an FP&A process? Finance transformation improves FP&A by reducing manual effort and increasing consistency. I would start by mapping the current process, identifying repetitive activities, inconsistent definitions, spreadsheet risks, and unnecessary approvals. Then I would standardize data and ownership, automate interfaces and recurring reports, and introduce controlled self-service analytics. Success should be measured through cycle time reduction, fewer reconciliation breaks, improved forecast accuracy, and more time available for business partnering. While answering, cover process standardization, automation, data integration, control design, self-service reporting, faster cycles, better insights, change management, and measurable benefits. Question 12. Tell me about a time you automated a reporting or planning process. In one reporting process, analysts manually combined several files before producing a monthly management pack, creating delays and version risk. I mapped the data flow, standardized the templates, automated recurring transformations, and added validation checks before publication. I tested outputs against prior periods and obtained user sign-off before deployment. The process became faster and more reliable, while analysts spent more time explaining drivers. I learned that automation succeeds only when ownership and definitions are clear. Be sure to mention the original problem, your role, tools used, process redesign, controls, testing, stakeholder adoption, quantified benefits, and what you learned. Question 13. How would you ensure data quality in an FP&A dashboard? I would establish data quality at each stage rather than relying on the final dashboard. That means defining metric logic, confirming source ownership, validating master data, reconciling totals to the ledger, and using automated checks for missing, duplicated, or outlier records. I would monitor refresh status and maintain an exception log with accountable owners. Before release, I would perform reasonableness checks and document the definitions so users interpret metrics consistently. Focus on source system integrity, clear definitions, master data, automated checks, reconciliations, exception reporting, access controls, refresh monitoring, and documented ownership. Question 14. How do you handle conflicting assumptions from different stakeholders? I first determine whether the conflict is about definitions, timing, data, or genuinely different expectations. I would bring stakeholders back to evidence, such as historical performance, contracts, pipeline data, capacity, and approved strategy. Where uncertainty remains, I would present scenarios rather than force false precision. I would document the selected assumption, owner, rationale, and review date. For material disagreements, I would escalate with a clear decision paper, not competing opinions. In your answer, talk about clarifying definitions, understanding incentives, using evidence, reconciling operational and financial views, documenting assumptions, escalating material conflicts, and agreeing on governance. Question 15. What KPIs would you include in an FP&A dashboard? I would select KPIs based on the decisions the dashboard must support. Financial measures might include revenue growth, gross margin, operating expense, EBITDA, cash conversion, and forecast accuracy. Operational measures could include volume, utilization, headcount, productivity, customer retention, or project delivery. I would show actual versus plan, trend, outlook, and variance drivers, with drill down by entity or business line. A focused dashboard is more useful than a crowded scorecard. Make sure to cover financial and operational KPIs, relevance to strategy, leading and lagging indicators, dimensions, targets, trends, drill down capability, and avoiding excessive metrics. Question 16. How would you manage a tight monthly reporting deadline? I would work backward from the deadline and identify dependencies, owners, cutoffs, and review points. Recurring tasks should use standardized templates and automated data pulls where possible, while high-risk accounts receive earlier validation. I would prioritize material management outputs, maintain an issue log, and communicate blockers quickly rather than hiding them until the deadline. After each cycle, I would review delays and control failures, then improve the calendar or process. While answering, focus on a documented close calendar, upstream dependencies, standardized templates, automation, prioritization, review controls, communication, issue logs, and continuous improvement. Question 17. How would you evaluate forecast accuracy? I would compare each forecast version with actual results using consistent horizons and definitions. Measures such as absolute variance, percentage error, and forecast bias show both magnitude and direction of error. I would analyze accuracy by revenue, cost category, entity, and driver instead of relying only on one total. A poor result may reflect exceptional events or weak assumptions, so I would combine the statistics with root cause review and targeted model improvements. Be sure to mention consistent measurement periods, forecast versions, absolute and percentage errors, bias, materiality, driver-level analysis, business context, and corrective action. Question 18. Describe a time you had to explain complex financial information to a non-finance stakeholder. I once explained a cost variance to an operational manager who did not work with accounting terminology. Instead of leading with account codes, I used a simple bridge showing volume, rate, timing, and one-time effects. I connected each component to operational activity and ended with 2 practical actions. I checked understanding through questions and confirmed the agreed interpretation afterward. That experience reinforced that effective finance communication starts with the stakeholder's decision, not the report format. Focus on audience needs, plain language, visual storytelling, business impact, actionable conclusions, checking understanding, and adapting the level of detail without losing accuracy. Question 19. How would you respond if a client requested an urgent report with incomplete data? I would first clarify what decision the report supports and which figures are essential. I would use the most reliable available data, clearly separate actuals from estimates, and quantify important limitations rather than presenting false precision. If necessary, I would provide a directional version quickly, followed by a validated report once the missing data arrives. I would communicate assumptions, confidence level, and timing, while preserving review and approval controls for any external or high-impact output. In your answer, talk about clarifying the decision, assessing data limitations, using reliable proxies, labeling estimates, communicating confidence, providing a phased response, and protecting control quality. Question 20. Why do you want to join EY GDS in an FP&A, BPRA, or finance transformation role? I am interested in EY GDS because it combines global finance delivery with process improvement, analytics, and transformation. The role would let me apply core FP&A skills while developing deeper experience with EPM tools, standardized reporting, automation, and stakeholder management across different businesses. I can contribute through strong financial analysis, disciplined execution, and a continuous improvement mindset. I also value the opportunity to learn from complex engagements and deliver scalable, controlled solutions. Be sure to mention EY GDS's global delivery model, exposure to varied finance processes, analytics and EPM capabilities, transformation mindset, stakeholder collaboration, learning goals, and specific contribution. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.